You ever notice how some names just seem to pop up everywhere, especially in the world of finance? Well, there's one name that's connected to pretty much every major company you can think of: BlackRock. So today, we're going to dig in and ask a simple question. Is a company like this actually making the economic pie bigger for everyone, or is it just getting really, really good at taking a giant slice for itself?
All right, first things first. To really get a handle on this story, you have to understand the sheer scale we're talking about. And calling BlackRock a financial giant, honestly, that doesn't even begin to cover it. The numbers are just staggering.
Just look at that number, $10 trillion. That's roughly how much money BlackRock has under management. Now, to put that in perspective, that is more than the entire annual economic output of every single country on Earth, except for the United States and China. So we're not talking about just a big company here. This is like a fundamental force of nature in the global economy.
Now, here's where it gets really interesting. You have that mind-blowing number on one hand, but on the other, you have the company's own mission statement. Their purpose, they say, is to help people achieve financial well-being. So the big question is, how does managing $10 trillion actually translate into that?
And this really gets us to the core of what we're exploring today. When we say a company creates value, what do we actually mean? Is it about making new things, innovating, building? Or is it about just getting better and better at moving money around? To answer that, we kind of need a new lens to look through. So let's break down two really fundamental and very different ways of thinking about the economy: the idea of creating value versus extracting it. First up, you've got value creation. The easiest way to think about this is baking a bigger pie for everyone. This is what happens when a company invests in R&D, builds a new factory, invents a cool new technology. The total size of the economy actually grows. There's more pie to go around. And the opposite of that? Well, that's value extraction. This has nothing to do with baking a bigger pie. This is all about fighting to get the biggest possible slice of the pie that already exists. This can be done through all sorts of complex financial moves that shift wealth around rather than actually creating new wealth. And here it is, laid out side by side. On the one hand, you have the value creators, the makers, who are focused on production and long-term investments. On the other hand, you have value extractors, the takers, who are focused on financial engineering and getting the biggest possible short-term payout. The huge question is, which one of these is winning out in our economy today? So let's see how this theory actually plays out in the real world. Let's follow the money and see what companies are really doing with their profits, because the data shows a pretty fascinating puzzle. We can start with a pretty simple question. We know that companies are more profitable today than they've been in a very long time. So where is all that cash actually going? Is it being used to bake a bigger pie? This chart shows you the first piece of that puzzle. See that trend line? It's been climbing steadily for decades. That's corporate profit margins. It means that for every dollar they make in sales, companies are keeping more of it as pure profit than ever before. To put it simply, they are flush with cash. And here's the twist. You'd expect all those record profits to be fueling a massive boom in value creation, right? New factories, more research, better pay. But that's not what the data shows. Investment in the making side of the economy, the stuff that actually grows the pie in the long run, has been surprisingly flat. So, if the money isn't going into building the business, where is it going? Well, a huge portion of it is flowing directly back to the owners of the company, the shareholders. This happens through things like dividends and, more, through stock buybacks. That's when a company uses its profits to buy its own shares just to push the price up. It's a move that definitely makes the stock look good, but it doesn't build a new product or create a new job. Now, this whole trend isn't just about a few companies making decisions here and there. It actually points to a much bigger, more fundamental shift in how we, as a society, have started to define what economic success even looks like. You see, it's really important to remember it wasn't always this way. For most of the 20th century, the financial industry was seen as more of a utility, like the plumbing or the electricity. It was a necessary cost to help the real economy of makers and producers actually function. Its job was to support the people making things, not to be the main event. But as you can see here, over the last few decades, that idea has completely flipped. We went from the past, where finance was just a cost, to the present, where we've basically redrawn the map of what we consider productive. Now, the financial services sector itself is seen as a huge positive contributor to our economic growth, to our GDP.
And this leads to a really strange outcome. Under a current system, if the cost of moving money around goes up, if finance gets more expensive and takes a bigger cut, our GDP actually increases. We literally count the fees paid to the financial sector as economic growth. We celebrate it, even if it just means the takers are getting a bigger slice before the pie even gets to the makers.
So, all of this brings us right back to where we started with BlackRock, and to this really fundamental question about what kind of economy we're actually building. Think about that mission again, to help people experience financial well-being. Is that goal best served by focusing on growing the whole pie, or has the system shifted to become more of a battle over the existing slices? As a financial giant that owns a piece of nearly everything, BlackRock's influence is immense. It's a key player in a system where that line between making and taking has gotten really, really blurry. And understanding that difference just might be the most important economic question of our time.